Professor Jeremy Siegel of the Wharton School, Professor of Finance. It's good to see you, Professor. Welcome.
Welcome, Scott.
All right, so you've had a chance to absorb a week, right? We've had a week.
Yeah.
What do you take from it?
I'm very cautious. I say if we don't get some breakthrough over the weekend, I think we'll see $100 oil next week. And remember, it began the year under 60. I mean, that would be if we do get that, that's a 70% increase in price. And that will set, I think gasoline is set to soar in any case. So I think there are headwinds. Now, your other guest thought that the tax refund might offset them, but I think that the oil shock actually could be bigger than what we get on the refunds, which were well advertised, and some people have probably already maybe spent their extra money. So I wouldn't be surprised to see a correction in the market. We haven't had one for a long time, and that would be, we're not even in the pullback zone yet, which is 5 to 10%. Correction is 10 and more. I don't think any bear market is coming. And by the way, if we get a breakthrough, we would get a coiled market spring upward. But trends look like this is going to drag on a lot longer than I and the administration had hoped.
Oil matters more than everything else. That's what I hear you saying, correct?
Yeah. In the short run here, oil does matter more than anything else. The price of gasoline is probably the most visible price of any price in the consumer basket. We're in a midterm year. Politicians are going to make an awful lot of it one way or the other. The Democrats themselves didn't like this war. They're going to blame the high price on gasoline on Trump. So there's going to be a lot of fighting back and forth on this issue. And it's from what I've talked to some oil experts, and the shutdowns, what is going on in the Gulf, what is going around the world in terms of shipping, it's cannot be fixed overnight. It's going to have some lasting effects, at least in the near term, on the economy. In the long term, I'm as bullish as ever, so don't believe that. But I do think that what I see short term does worry me.
But outside of oil, what inside the market is most concerning to you? What group? Is it the banks? Is it the private credit related names? Which ones?
Well, I'm bullish on everything. I actually was a little puzzled about the jobless number that we got today, the jobs number. If you take every short-term labor indicator, the jobless claims, the Challenger layoff reports, the ADP weekly reports that we get, all those, and the ISM reports, even unemployment, they didn't show a big decline. Hassett said maybe we should just take the 3-week average. But I think one thing is really interesting and I think very positive, and that is GDP estimates have not really gone down. Now, I know Atlanta just lowered theirs a little bit this afternoon. Goldman Sachs is still over 3% for the first quarter. Now, think about that. With a job loss and still having over 3% GDP, what does that mean? That means productivity is really exploding. And that's ultimately good for real wages, good for the economy. And we saw the trend in those last 2 quarters. It would continue. I think if this war gets resolved, boom, we're going to get on. But if it drags on, the visibility on oil prices is going to be a drag.
But if I asked you, I said, hey, what about the banks traded poorly? What about private credit? Big concerns there. And you said I'm bullish on everything. Neither of those things concern you at all?
Well, the private credit, if you take it the marketable, the spreads on the marketable bonds that are investment grade versus non-investment grade, they have come up a little bit, but not very much. And, this whole thing about private credit, and they enter an agreement saying you can take 5% off, and then when you want to take more, everyone panics. Well, hey, that's what a long-term illiquid investment is supposed to be. Now, that being said, I do believe that the space got overcrowded, and would not be surprised to see some investors in that space taking some big losses. But the only way the banks are going to be taking big losses if we have a recession. Could you say these higher oil prices could bring about that? Given that we have virtual energy independence, it's a very different story than the 70s and the 80s. So, yeah, slow down, no recession. That's what the bank loans and the bank portfolios are. I mean, we see really no other slides in the assets, not a crazy mortgage situation like we had before the great financial crisis or anything like that. The balance sheets of banks, I think, look still very, very good.